Now, in the post-financial crisis period, DTCC must again rethink and reimagine our processes, this time focused on the ongoing cycle of risk mitigation and risk-taking. We must adopt a risk methodology that plans for the unthinkable and unimaginable to ensure that it never comes. In that reimagining, we will be working, as you do, with the 3 lines of defense model. The first line is in our individual business units. After all, the businesses own their risks. They have to identify and measure them and judge how effectively they're being controlled. But today's new premise is that risks that the businesses might once have tolerated now must be addressed, and ways to reduce them developed and implemented. And when that process is completed, we have to start it all over again. Unlike physics, there is no steady state in risk mitigation. Every time we reduce particular forms of risk, we have to go back and assess the risk picture again with an even more powerful lens. Our second and third lines of defense, as is common in the industry, rest with our specific risk control areas, the enterprise and operational risk management units, and our internal audit group, respectively. Significant steps forward will be taken in all of these areas to upgrade their capabilities and to ensure that these areas are prepared to challenge our thinking and certainly our complacency about the levels of risk we think we need to tolerate. In short, we're ratcheting up the organization's RIQ, or risk intelligence quotient. We need to rethink years of habits and behaviors in order to recognize and tackle risk in all its variations, old and new. Fundamentally, this is a zero-based remaking of our approach. We're going to start at the baseline, and that may force us to rethink many of the assumptions behind the practices we've employed and the services we've been offering our participants for decades. In other words, we will find ourselves looking at things and doing things very differently. By now, I suspect that many of you are beginning to think, uh-oh, what's this going to do to my business and the way I use DTCC's services? How will it impact my systems? What's it going to cost? These are all very good questions, and we understand very well that we need to give you answers. Since this effort requires us to sail into the unknown, however, we don't have all the answers yet. And that's the unpredictable environment we'll need to manage in the coming years. For example, NSCC has never applied any kind of debit cap restriction on the end-of-day net settlement balances its members can build up during the course of a particular day. That has been the practice since NSCC was founded. We've always done it that way, and we all and you all have systems and procedures built around that. But that does impose a serious daily liquidity risk on the clearing corporation. And we now understand that we need to find a way of controlling that. As another example, in risk tolerance formulas, the industry standard is typically 99% certainty. That is a pretty high standard. But the bar has been raised. And one could argue that a clearinghouse needs to seriously think about reducing our risk tolerance level still further. That, too, is a policy decision that we're going to have to explore. Clearly, we have to keep costs in mind as we weigh that decision. But we also have to recognize that the benefit side of that calculation must factor in the prevention of far more costly problems or errors somewhere down the line. In short, we all know that remaking an entire process with far more checks and balances will not be easy or cheap. There will be costs involved, and there will likely be some increase in fees. We will be aiming to provide some guidance to you on this later next month. Just as important, we need to collaborate with you in this effort. We need to run ideas and thoughts about tolerances and procedures by you. We can't and we won't do this in a vacuum. But mitigating risk is not simply a matter of increasing the margin reserves against it. This new challenge of mitigating risk will demand relentless experimentation and the bursts of innovation that can flow from that. In fact, we already have innovative initiatives underway that will help you even more efficiently use your capital. New York Portfolio Clearing, for example, our joint venture with NYSE Euronext, is designed both to provide unprecedented transparency for market overseers by giving them a simultaneous view of both futures and cash markets for government securities. It's also designed to provide you with much greater efficiencies in margining. Or consider our intent to launch a new central counterparty for mortgage-backed securities. It will provide the safety of a trade guarantee to this market for the first time ever. But it will also reduce risk and costs in the handling of the underlying mortgage pools. The challenge of overhauling our systems and processes from the ground up may seem daunting, but we are very confident we can do it. Part of the challenge, of course, is that we'll be doing it within a regulatory environment that's already beginning to change as a result of the forces the Dodd-Frank bill has set in motion. So let me talk about how DTCC is also transforming our relationships with our regulators and our efforts to monitor and shape public and regulatory policy. DTCC has long had a close working relationship with our regulators, a relationship we value very highly. The new world of risk mitigation will demand that this become an even closer, tightly coordinated relationship for DTCC as well as for all financial institutions. Our regulators need to observe and play a major role in this remaking of our risk knowledge and our risk thinking, and we want to ensure that they do so. A major new player in the regulatory field will be the new Financial Stability Oversight Council that Congress created in the Dodd-Frank bill. It is an independent 10-member committee that includes representatives from across the regulatory spectrum, from the Treasury Department, the Federal Reserve, the SEC, and 5 other agencies. This new council will have the authority to determine whether DTCC is a systemically significant financial market utility. And if the council says to us, yes, you are systemically significant, as obviously there is very little doubt that they will, then the Federal Reserve will become the prudential regulator for all of our regulated subsidiaries, as it is today for DTC and Warehouse Trust Company. To back up its powers for monitoring systemic risk, the new Oversight Council will rely on another new agency, the Office of Financial Research, to collect and standardize data from financial services companies, to perform research, and to develop risk measurement and monitoring tools. Based on our interactions with the Treasury and with the others involved, we expect that the OFR will collect significant amounts of position, transaction, and counterparty exposure data from throughout the industry. They could requisition the data directly, but hopefully they will take the alternative approach of obtaining it from central data stores such as DTCC. Given our unique position in the cash, equity, and fixed income markets, not to mention the depth and quality of the over-the-counter derivatives data we keep in our trade information warehouse, we are quite clear that we have a role to play in aggregating data for the new OFR in ways that would take the burden and costs off you as individual companies. And that's certainly something that we are working on in Washington right now. There are other new agencies created by the law that could also have an impact on our business and on yours. But the changes most likely to affect our industry will come out of the enormous rulemaking process that is now getting underway. By one estimate, the financial reform legislation in the U.S. calls for 243 separate rulemakings and 67 individual studies that will likely lead to more rulemakings, most of them to be completed within 12 months of the bill's passage, that is, by next July. Another analysis finds that the number of rulemakings required under the bill is more than 30 times that required by Sarbanes-Oxley, which resulted in only 16 new regulations. So it's no surprise that the regulatory agencies are hiring hundreds of additional people to meet these congressional deadlines. During Congress's consideration of the Dodd-Frank bill, we tried very hard to ensure that legislators understood the critical systemic risk concerns if the final bill inadvertently led to the fragmentation of the OTC derivative information we now hold centrally in the Trade Information Warehouse. Thanks to some strong support from key members of Congress, especially Senator Schumer and Menendez, we succeeded in that objective. We're hoping to have the same opportunities to work with the regulators in their upcoming efforts to make further contributions to reinforcing risk safeguards. Europe, as you may know, is also hard at work on remaking their financial markets. They are prepared, for example, to impose uniform market requirements for the first time throughout the 27 countries that make up the European Union. And that's a move I expect all of us would welcome. Earlier this year, we spent a lot of time and effort meeting with European policymakers to educate them on who we are and what we do, and to make sure that the European regulatory consensus on OTC derivatives also provided for reporting those trades to a single repository for each asset class. But we've been doing more than simply talking. We've taken concrete steps to allay European concerns about access to the data that we hold in our trade data repositories. Last month, we launched a European subsidiary called DTCC Derivatives Repository Limited, very catchy name, which will maintain global credit default swap data identical to that maintained in our New York-based trade information warehouse. This European-based repository will support a wide variety of critical functions, including, most importantly, CDS trade reporting to support the transparency needs of regulators and the public. Last year, as you may recall, DTCC won the contract to build a similar repository for global OTC equity derivatives, and we have now opened that facility in London as well. Our goal is to avoid a proliferation of redundant regional trade repositories that would further systemic risk. We've made clear to regulatory agencies that function outside the United States that the data we collect from across the globe will be available to any of them with a legitimate interest in the data. Another step we took in August was to add additional data to what we already publish about credit default swaps. We're working very hard to expand transparency in this global market. Making this change, in effect, sailing out beyond the edge of the map of the known world, is an enormous undertaking. But as we often say at DTCC, risk mitigation is in our DNA. It is what we do. And now we're simply going to do more of it, more often, and more fully.